everybody, it's Walter here, and you're here at the Naked Forex webinar, and I just want to make sure that the sound is okay and that you can hear me all right. How is that sound coming through? Pretty good? Brilliant. Thank you. Thank you. Hello, Beta. Thanks, Adinda. Hey, Jason. Asma. Welcome. Thank you so much, John. Hey, Charles. So today, folks, we're here and we're going to talk about the trend formation. It's a forgotten trend formation that most traders have long forgotten, and yet it involves no indicators. It's easy to see, and it's extremely easy to trade. So let's jump into it. Hey, Chris. Kieran is here, and DZ Bista's here. Welcome, welcome. So let me. I just want to. I'm interested in the people who are here. So many familiar faces, which is awesome. So let's get into it, guys. So those of you that are new here, my name is Walter Peters. I trade without indicators. I wrote a book about it called Naked Forex. And in fact, I'm in some naked trades this week as well. Because most traders I know have jobs, I like to show people how to trade the higher time frame charts. A lot of myths about the higher time frame charts. Things like you need to have a large account, or you don't make as much money, or blah blah blah. And I've talked about those at some of the other webinars. Probably won't get into that tonight or this morning if you're in Europe or New York for that matter. So probably won't get into that. But just suffice to say that you don't. The size of your account doesn't determine the time frame you have to trade. There are plenty of brokers that I'm sure you can find who will offer you the opportunity to trade at custom lot sizes, which means, of course, it doesn't matter if your stop loss is 700 pips away or 7 pips away, you can still risk the exact same amount. So that's really important to talk about, because that's one of the barriers that people come up against psychologically when you're trading the higher time frames. What I'm going to show you today is a very simple strategy. It's not my strategy. I first learned of it when I read a book by, has anyone read the book by this fellow? I'm going to write his name on here. I believe that's the correct spelling. Nicholas Darvis. How I Made $2 million in the stock market, or something like that. What's it called? Does anyone know his story? Yeah, I spelt it wrong though. There's no H. I wondered about that. It's Nicholas Darvis without an H. So I almost spelt it the right way, and I'm thinking that it didn't have an H, but I said, no, that doesn't make sense. So the story, hey, Jeremy, welcome. Hey, Glenn. Pam is here, and Chris. Kieran, welcome. So the story with Nicholas is that Nicholas was a dancer. I think this was in the 40s or 50s, 1940s or 1950s. Pretty sure it was the 50s. But anyway, he was a dancer, and he got to travel the world as a dancer. But he started getting into stock trading. And he came up with a system all on his own about finding really good stocks. And he would call, of course, in these days, you would call your broker. In fact, it wasn't that long ago when I used to call my broker, and we would get charts sent to our house every week where we could pour over all the charts in these telephone book-sized books that would come in. But those days are long gone, aren't they, with electronic trading? But basically, he would call into his broker, and he would say, buy so many shares of this stock or whatever, and basically then he would buy more, and he would actually just hold tight, and he made a lot of money. He made, as you say, $2 million back in 1950, let's say. I'm not sure if it was the 40s or 50s. I think it was, in fact, after World War II. So that would have put it in the 50s most likely. But $2 million back then, you think about it in terms of the amount of money that would have been like making $100 million today. So that was a lot of money back then. And so I know it doesn't seem like that much now, but it was definitely a lot of money back then. So what I'm going to do is I'm going to show you my interpretation of how he did it. I'll actually show you the very first trade that I used doing exactly what Nicholas Darvas did. And that trade is actually on this chart right here. What was interesting to me about this trade when I took it at the time was all of the one of the questions I get a lot as a technical trader is, do you use fundamental analysis? And those fundamentals are really, to me, hard to, it's hard for traders to interpret the news as everyone else does. I think that we're kind of odd people and we're a little bit different. We see things a little bit differently, so it's often difficult for us to see the world the way everyone else sees it. So I think it is possibly easier to trade technically than it is fundamentally. Now, everyone's different, of course, but what was interesting about this trade when I took it, I was using the Nicholas Darvas system of trend trading, and or at least my interpretation of it. And every single fundamental analysis study that I read or opinion, online article, told me that the trade that I was taking, which was buying the yen, and I literally bought the yen down here, right? It would have been above this candle right here. So this trigger is actually a trade in and of itself. We're not going to talk about it. We'll talk about it probably at another webinar. But this right here is a trade in and of itself. And everyone was saying that the yen was going to strengthen. In other words, the chart was going to go down. And all I did was I kept buying the dollar yen, which is, of course, selling the yen and buying the US dollar. So the trade was triggered here, and I was adding to the position as it kept going up. And then I think finally here is where I dumped it. So it ended up being a fairly long-term trade. And I remember thinking when this day happened, I'm so glad that I got out because it dropped off the cliff here, of course. And then it sort of chopped around a bit. So let's talk about the specific rules. Yes, beta, my entry was the belt. Fundamentals indeed. Fundamentals are when we come up with reasons why things are the way they are, which is basically what fundamental analysis is, in my opinion. So let's talk about it. So I'm going to show you how you see these boxes that Nicholas talked about in his book. If you haven't read his book, it's not really good as sort of like a trading book. It's actually probably much better. It's probably much better as a story. It's an interesting story, but it's not necessarily what you would call like a good sort of how-to. He doesn't really go into the how-to that much. It's more just kind of about the story of how he was a stock trader while he was traveling the world as a dancer, which I just love that. I love, one of the things that I think it's so great about trading is how, you don't really have to have any sort of background in anything to be a trader, right? You really don't. You simply just have to have a profitable system and the right mindset, really, and then go execute it. And that's exactly what Nicholas had. So let's get into his rules. The entry for me was the belt here. There was sort of like a double bottom action happening here. You had a touch here, and then it came down here and touched there. But once the belt printed, I was pretty happy to go long. A lot of people probably would have shorted this and thought it was a head and shoulders, especially on all the fundamental news that was out at the time saying that this chart was going to fall. Now, I remember kicking myself going, I can't believe, these guys are saying it's going to fall, because it was conflicting to me. And, at the time I paid more attention to fundamentals. And I kept thinking, well, what do these guys know that I don't know? But anyway, I kept adding to the position after each box here formed. Now let me show you what these boxes are. Essentially, for this system, what we need to do is establish that you're in an uptrend. Now, for a lot of traders, that might be making a new high, which in this case might be waiting until the market clears this area here and closes above. So the highest close that we see over here is actually this kangaroo tail right here. A lot of you know what a kangaroo tail is, right? That's clearly a kangaroo tail. We have one on the euro right now. We'll get into that later if you guys want to talk about the live charts. Certainly happy to do that. Probably the second half of this session. So this would be, if the market can close above this yellow line, then we're in an uptrend. And that's when it happened right here. Now, for me, what I look for is a consolidation of at least 3 days. So this area right here where it has these two candles wouldn't really count for me unless somehow I squeezed this third one in here and said that was 3 days. So I really want to see at least 3 days where the market doesn't really go anywhere. It doesn't really go up. It doesn't really go down. It just kind of goes up and down. And then once that happens, you get a really strong breakout candle outside of that box. Now, these boxes are consolidation boxes, and that's what Nicholas Darvas looked for. He was trading stocks, of course, back in the 50s, but basically he waited for the market to consolidate, and then he waited for the market to break out of that consolidation. So I'll mark all these breakout candles here for you, but essentially, once the box is formed, we're on high alert for a breakout candle that breaks out beyond that box. Probably the easiest way to do it is to wait, for the market to close above the box. But you can do it if the market goes higher than the box. The problem is you're gonna get taken out sometimes, like by these false breakouts. See, you have one right here. These at least one candle right here, this kangaroo tail, was a false breakout. You also have a little spike right here on this one. It's kind of better, I think, to wait for the close to confirm the breakout. But there you go. Yeah, he did this during 1957 and 1958. I think that's when most of this happened. So he made 2.45 million in 18 months. Okay, so let's talk about the rules, guys. Let's get into the specifics. So this is how it works. First of all, you have to. So I'll write the rules up here. I like to do this during our webinar so everyone's clear on what I'm talking about. So one is wait for a trend. If you don't know how to define a trend, we've talked about how to break down the naked structure or price action structure of a market to see that it is in a trend. So you might have to go back and watch one of those webinars. But a simple way that we can cover right now real quick, just so you have a grasp, is to wait for the market to make a new high. So the local high at this stage is this high right here. So if we want to say that the market's in an uptrend, we want to see it break above this high. And it did, of course, on this candle right here. So at this stage, we say, okay, it's cleared the highest close over here and it's closed higher. Now let's see if we can get a consolidation. And here we do have consolidation. And then finally, we have a breakout candle right here. So the first thing is to wait for a trend. The second thing is to wait for a box. This is what they call the Darvas box. And the box has at least 3 plus 3 or more candles. So a box must contain 3 or more candles, right? And then finally, the last step is wait for the market to close above the box. Obviously, you can do downtrends and you can wait for the market to close below the box. Doesn't really matter. Buy or sell. trigger candle closes above the box high or below for a bearish market. So I'm just going to talk about in terms of uptrends here, but obviously you would have the exact same rules in reverse for a downtrend. The trigger candle would close below the box low. But in this case, since we have an uptrend, we'll talk about how the trigger candle has to close above the box high. Or actually, another way to say that is the highest close. I should actually clarify. Trigger candle closes above the box high close. Remember how I was talking about over here? See how this wick right here? Let's actually focus in on this because this is very important. See how what I want you to notice here is the highest close we had over here on this swing high was this candle right here, this kangaroo tail, and that closes at 112.89. And then finally we break it here when this candle right here closes at 113.29. So it went 40 pips, right? Sorry, 30, 40, yeah. If this closed at 89 and this one closed at 29, that's 30 pips, right? Yeah, 30 pips. 29 plus 39 pips, yeah. Yeah. All right, so it's like basically 40 pips. So now I don't know why I don't know why I'm so tired, other than the fact that I was up at 5 a.m. today with the 1-year-old. Okay, sorry, brain fart. Let's keep going. So now what we need to see here is the market. Once the market, let's say that we didn't even count this signal here, okay, or this one here. So you had 3 candles here, not going anywhere. Then you see an explosion candle. So these are the candles that close above the highest close. Close above the highest close, close above the highest close, close above the highest close. So what do? We get in on that candle. So these are daily candles, but of course you could work on 4-hour candles or whatever. But see how the market closed right here? I get in on that close. I could be conservative. I can be very conservative and go, well, I'll just put my buy order, 5 pips plus the spread above the high of that trigger candle if I want, and then get triggered the next day. Or I can just get in on the close, right? As soon as the market closes, 5 p.m. New York time I use on my charts, then boom, it's in. And so what I did in this trade, I actually got in on the belt because it looked like a nice sort of bottom here, like with these touches. And I put an order above that and went higher. And then every time it boxed up and exploded, I would add another position, right? And so by the end, when we got to this box right here, now let's talk about the exit, because what happened here was we had a really nice box right here. Actually, you could probably, I wouldn't, include this one right here because it's the only candle that has a low down here. I would actually include these 3 candles, this red one, this little wicky one, and this green one. I would say that that's a box. But what's interesting about this one was that you didn't see the explosion candle here. See how that works? On all of the trend continuation patterns where you have the consolidation and then the explosion candle, the market actually took out the high. Over here, it never took out the high. In fact, it printed a bearish belt right here, which was an excellent reason to get out of this. And that's exactly what I used. So even though I was waiting to go long here, I didn't, and I got out here. Now, one of the things that you'll notice if you add to positions, you will always see that your last positions are going to be your worst ones, really. So your last positions are always going to be the ones that make the least amount of money, and some of them are even going to lose money. But that's okay because the ones that you piled on the way up, those actually made money. You know what I mean? So that's not a problem because all of these, boom, 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 bam, those were excellent ones that made money. Now, what you'll notice in these trends is, in these Darvas box trends, is that the market will often spend very little time going straight up and a lot of time consolidating. So if you look at all the candles here in the trend, a lot of them are in the box, right? In these boxes, and very few of them are between boxes. That's very typical of this type of trend. This is not the type of trend that you will always see. It's a specific type of trend that occurs. There are other sort of trend continuation patterns. We've talked about some of those in some of our webinars, but I think the important thing, from our perspective here today is that we get the rules down. And the rules are, again, 1, wait for a trend, however you define that. 2, wait for the box to form, which is going to be 3 or more candles. And 4, wait for that trigger candle close. The close is critical, guys. The close tells us that the market is actually taken out the box. So when we see this close on this, and notice how all these candles almost close right on the high. Very, very characteristic of what you're talking about. If we could flip this chart upside down and see it as a downtrend, same thing. We'd see these candles close near the low, right? These explosion breakout candles should close down near the low. That's just the way it works. Okay. Are there any questions about this? Beta. In each box, there are good inside bar setups. Yeah, sure. I mean, we've talked about those, haven't we? Certainly, inside candles are another way to trade the trend. We've talked about those in other ones, in other webinars. Just before the breakout. In each box, there are good inside. Just before each breakout of the box. Yes, that's right. Oh, yeah. So Beta's talking about trend line. So also, if you were using a trend line here, when you see this belt print, you would probably say the trend line was broken. Some people, though, I will say, some people might have thought that the trend line was broken maybe a little bit earlier. Let's say that you drew, something like this trend line. Actually, I was trying to draw this trend line. One of the problems with trend lines, and I'm glad this came up. So I'm going to delete this lower trend line because I think we can all see that one. But look at this one. If we try and connect this trend line, what you'll notice is, see how this box here consolidated for quite a while? It was a couple of weeks. That's when we would say the trend is over. But if we use the box hopping, where the trend keeps hopping to the next box and pauses in the box for a while, then hops up to the next step. It's like a stair step, If we use that framework instead of the trend line, then we don't think that the trend is over here. Whereas if we were using this trend line, we might say that the trend is over. I'm not saying that trend lines are bad. I'm just saying that sometimes when the consolidation lasts too long, a trend line will break down, whereas these stair steps will keep going, So just something to think about. Just something to think about. And maybe even other traders were like, oh, like they were okay with it. Like they were, they might have, maybe they drew something like this and they were like, oh, that's okay. Like if they had a trend line like this, then they go, oh, well, like, for example, I'm talking about this day right here. So it's okay. We're on the trend line. We'll probably bounce tomorrow. Actually, no. And I clearly remember when this day happened, and I remember thinking to myself, because I looked at the quote on my phone and I said, there's no way it's at 117 or whatever it was. It's like, no. It's not at 117, It's it's at 119 or it's at 120. It's not at 117, but it was. It sure was, and it fell off the cliff. So one of the things I want to point out here, and one of the reasons why I find this pattern useful, is that where other things break down, like for example, if you threw a stochastic on here, I don't know, I haven't done it, but let me just let's see. If you threw a stochastic on here, I'm willing to bet that you know you get sell signals inside the boxes, right? And of course, those are going to be losers, you know? Every time, okay, so look, the stochastic was pretty much over bought for most of the trend. So let's see, where do we get our sell signals on a stochastic? So we had one here, which was a loser. We had one, it's like right here, which was also a loser. Like, I don't know how you make money on these sell signals. I'm not sure how that's possible. Another loser. And this is just, the breakdown of indicators. When do indicators break down? Basically when you use them. No, no, that was kind of funny. When, when do they break down? They break down in the trend, like these oscillator type indicators. And I don't want to pick just on the stochastic, but I know it well because I used to trade with it. And you can see the only sell signal that would have been good for any pips would have been the last one here. So just want to point that out, that other ways of characterizing the market might not work in terms of like trend lines, stochastics, or even MACDs or whatever, things like that. Probably is going to break down, whereas this is not a bad way to see a trend. Now, what happens if your trend doesn't fit this formula of boxes? Well, what you'll notice if you go back and look at a lot of trends is a lot of trends actually have a different type of consolidation, and they often have these flag type consolidations. Let's see if I can find one here. Well, here's just kind of here's another one that would have worked okay. Yeah, here, let me show you. Actually, let me back this up and see if I can find a good one. I want to find a really solid trend. Okay, here it is. All right, here we go. So a lot of times what you'll see is this. You'll see these flags go, right? So it's a market downtrend, and you see these little these little retraced channels like this. That can be quite common, actually, that you see that. So you see the downtrend, right? And then you see the channel up, and then it falls out of that channel, and then it like that. So these are not flat consolidation boxes like the Darvas box, but rather they're little flags up. And those are actually, I would say, I mean, it depends on the market, but those are usually more common than the straight boxes like we've seen. All right, so let's keep going and get back there. Are there any other questions about how this works? It was a great exit signal, yeah. How much did I add? I added a same lot size. So, some people, when they add positions, they add more later, or they add the biggest position in the beginning and they added smaller positions. But I added same size. Yeah. Yeah. So it depends, different rules and different strategies. Like some people have rules, like, for example, you guys know the Turtles, the famous traders. They had rules where they could only add X so many positions before they were fully loaded, and then they couldn't add anymore, even if they kept getting signals. So they, at a certain stage, they were fully loaded into their trades, and they were stuck there. They weren't going to add anymore. Charles, do you only place trade before the start of the trading day? Generally, Charles, what I like to do for my daily chart trades only, is I like to place my order after the Asian session. The reason why is if you go back and look, a lot of these wicks are formed on the daily charts during the Asian session. So in other words, the Asian session might go up and the rest of the day it goes down, or vice versa. So I generally would, now in this strategy, you can just go ahead and get in on the close. But generally, if I'm putting an order above a high, for example, of a daily candle, I won't place that until I'll wait for the Asian session to wind down, and then I'll put my order in. Asian isn't likely to be a turning point. It's likely to be the wick. Let me show you what I mean by that. Let's just go ahead and take yesterday's candle on the yen, for example. I don't even know if this is going to be a good example. If it is, then great, good for me. If not, I'll have to find another one. But, okay, here it is a good example. So it's exactly what I'm talking about. So this red line is where yesterday started. And so yesterday, these are 1 hour candles, by the way. And we're in a big blue consolidation box. That's why this is all blue. But essentially, during the Asian session, what happened? The market, although it briefly traded up, the Asian session went down. And then it went up. And actually, at the end of the day, the market actually closed slightly up. So yesterday was an up day. And during the London and New York session, it essentially went up. Is that 19 pips, something like that? But that's kind of the typical thing that you see. You see the Asian session kind of drift around, usually the wrong way, like this. Yeah, it went up, and the rest of the day it fell. It's not always the case. Like, for example, in Asia, it fell, and then the rest of the day, it just kind of consolidated. So and actually, the yen is probably one of the worst pairs to look for this pattern. It's much more likely that you see this pattern on pairs like the euro or the pound. But here's another one. Asia ended up going down a bit, and at the end of the day, it closed up. So it's not always the case. Here's a day where it just went up basically all day. It went up, and then it consolidated a little bit in the beginning of Europe, and then it went up during New York. So here's another one. It went down during Asia and went up for the rest of the day. So a lot of you who watch a lot of my webinars have seen me talk about this, and I'm sorry for beating a dead horse. But for those of you that are new, it's a good thing to, keep in mind. Yeah, so Asian is generally, here's a way to look at it. These wicks on the candles, here's another way to look at it. These wicks on the candles, they're usually formed during Asia. So this wick right here on this daily candle, that's usually means that it was formed during Asia, right? This wick right here on this candle, probably formed during Asia. This wick on this little green candle, probably formed during Asia, and so forth. They can sometimes be formed the last 2 hours of the New York session as well, but generally speaking, you get a lot of wicks formed during Asia. Pan. The difficulty for me with the trend is to identify them to be sure not in a ranging market. How do you do it? The use of moving average crosses? No. For example, what is the trend of the U.S. dollar? Okay, all right, let's do that. All right, this might be a good transition. I actually wanted to show you one more quick example of the Darvas boxes, and then we'll jump into the trend. So here's another one, guys. I just want to show you Aussie Swiss 4 hour. Same sort of thing. You've got a box, right? You've got a box here. This one's a little bit tricky because it did come down a bit, so it almost has that sagging thing. but you did get a close above these highs over here with this little candle. Maybe you waited until one of these later candles over here. Here's another one, box, and then nice explosion, box, and then nice explosion. Another tiny, teeny box, and a really nice explosion. Another box, and a great looking explosion. Again, these breakout candles should be really big candles. Finally, you get a box here, and what happens? Nothing. The market never breaks out of it and starts to go sideways. So it's over. If the market goes down and consolidates below the box, you know it's over. It's over. It still went up a little bit, but there's no reason to mess around with this and assume it's a trend because it's no longer following the box explosion pattern that we want to see. Now let's talk about trends and defining trends because this is critical. One of the things that I would say, okay, so here's a great example. This was a kangaroo tail on the, this means that my euro pound trade is back in the money. Awesome. Okay, cool. All right, just want to check my trade here. All right, awesome. Okay, so this was a trade that I was actually interested in yesterday. It was a kangaroo tail. New Zealand dollar, US dollar. Yeah, I have a trade set up on that one as well. I'll show you that on the weekly chart. But essentially, this was a kangaroo tail here. Why did I not? Okay, for those of you that know the rules of the kangaroo tails, you usually get in above the high of the kangaroo tail right here, where my cursor is, and then the stop loss is down here. Why didn't that happen on this trade? Well, if you follow for those of you that obviously follow my videos and stuff like that, you know that there's no way that I'm going to get in this trade during the Asian session. Well, this wick right here, go back and look at it if you don't believe me. But yesterday, this high was made during the Asian session. So what that meant was my buy order was just lifted up, and it was moved all the way to 35.56. So if the market was actually going to, trigger my trade, it would have to go to 35.56. Now that means that my first target here is probably not going to work. It's just too close to the entry price. But my second and third targets would have been fine, However, look at what's happened. Today, the market never went to 35.56. It never took out yesterday's Asian high. And again, one of the things I mentioned about this kangaroo tail, if you guys have access to my videos, I say, yesterday's candle ideally would have looked something like this candle. It wouldn't have traded any lower than this candle. And although it could have traded above the high of the kangaroo tail, it shouldn't really trade much higher than the kangaroo tail. It's sort of like this candle over here, sort of like its twin brother, But instead, we did trade quite high, and we actually did trade quite low, although it snapped back up and closed in a reasonable position and respected the support resistance level right here. Today, clearly, we've already traded to where the stop loss would have been if the trade were triggered, but it wasn't triggered. The trade was never triggered. The trade was never entered, and therefore, I would say this is a bearish trend. Why is it a bearish trend? Well, we had consolidation back here, clearly, right? So this is all consolidation. Yeah. Consolidation right here. All right. Then we see the market break out lower, and then we see it come back up and touch this level. Like, it's funny that the market does exactly what. The reason why I drew a gray box here is because I said the market's probably going to come up there and hit it and then fall. Well, that's what happened. It's not rocket science. It's just that this is where the support was over here. So that's where the resistance was going to be, and that's what happened. So now, because it's making a high, and then this high, I know it's technically higher than this high, but this was more of a consolidation box. This was more of a swing high. So if I look at the line chart, here's your high, here's your high, here's your high. Now we're making lower mini peaks. I expect the floor to fall out, and I expect the euro to fall, especially if today's candle closes below the kangaroo tail on Friday. Friday was a kangaroo tail, and so I think, let me just back this up a bit. Yeah, if the euro can close below, see, let's just take a look at the chart here. this is a really good question. Okay. The lowest close I see on this line right here, and I'll just make it green so it's easier to see for everybody. But, the lowest close on this green line, actually, that might not be any easier to see. The lowest close on the green line it looks like it's this one. So that's 34.72. So if today we can close below 34.72, the low is 34.77, by the way. If we can close below 34.72, which is the lowest close going back here, unless this one, I don't think this one's any. Yeah, this is 34.73. So basically, all of the support here on this level, and the lowest support that we found was right here. Basically, that's what I'm looking for. It was this candle right there. So what that means is, I think that the euro is really ripe for a fall all the way down to this area here. I mean, the euro could be a really fun pair to trade. The other thing I want you to notice is on my euro pound trade, this was last week, and this is kind of, what we were looking at earlier on the boxes, on the Darvas boxes, because what do we have going on here on the euro pound? We have these boxes and then breakout candles, and so my trigger for the trade was essentially this big red candle right here. And so I said, the big red candle was the reason why I want to get in this trade. It's completely taken out all of these little candles that were in consolidation. And so now, basically what I did is I just waited for a retrace to 79.16. So it's up where this yellow area is. If you look on the 4 hour, it's easier to see. So basically, once it did this big fall down, I said, okay, it's probably going to come up, and it's probably going to come up to this area here, and that's where I'll get in and enter my trade. And so then it kind of just messed around the last couple of days. Now it's finally, hopefully, it looks like it's going to fall now. So this is really lining up. And again, you could also draw another box here, couldn't you? You could also draw another box here and say, look, this market's been consolidating, so we just need to see it break out, and a big red candle close below this low down here of 78.89. And if it does that, we're off to the races again. I think given the look of the euro right now, that's probably pretty likely to happen on the euro pound as well. So that looks pretty good. Beta jumped in on the 4 hour one. Okay. All right, guys. Yeah. If you come to I have a webinar in the first hour of the week, and we talked about this. I mean, I talked about it. It's all on the recording. So basically, okay, couple of problems I had with the 4 hour. First of all, you're right. The candle itself is brilliant. It's beautiful. It is. There's nothing wrong with it. The issue is that the daily kangaroo tail happened on a Friday. That's really bad. And the other issue was that Monday it actually broke and went pretty high, which was also bad. Ideally, if this was going to be a good kangaroo tail, it would have just lazed around on Monday, and today would be the day that we're rocketing up. Instead, today's the day that we're rocketing down, and of course that means that we've taken out the low of this kangaroo tail already, so it's already a busted kangaroo tail. It's already time to think about reversing this sucker and selling it. But again, a couple of things that I should mention. Just like the Asian session is a great place to see the market go in the, quote, wrong direction, the beginning and the end of the week is a great place to see the market go in the wrong direction as well. So in other words, Mondays and Fridays. Let me show you what I mean by that, and I'll move to the Kiwi because we had a question about the Kiwi. And here's why I say this. I'm going to sell the Kiwi when it breaks the low of last week, which was 86.48. So probably around 86.40, 86.42, right around there. Now, what I want you to notice, like let's just say that this week's candle ends up being a big red candle and falls all the way down to here, all right, to 85.55, which is quite doable given that that's where the support is right there. As you can see, all these candles were held right there, and these candles found resistance there. So it could definitely fall down to 85.55, no problem. Now, here's what's interesting to me is that this wick on this candle is probably going to be formed yesterday, which was Monday. And if this candle is, if I'm fortunate enough to see this candle fall all the way down here this week, maybe not this week, maybe it happens next week, but if it falls all the way down here, there might be a little tiny wick down on the bottom of it as well, because the market snaps back up, especially when it hits a support level. That was probably most likely going to be formed on a Friday. So in other words, just like the Asian market drifts around and goes in the, quote, wrong direction, so does the weekly candle with the Monday moves and the Friday move. The best time of the week for me as a naked trader to take trades is like Wednesday, Tuesday, Wednesday, Thursday. Those are the days I want to get into my trades. Don't want to get on a Monday when the Euro kangaroo tail was triggered and all that. Don't want to get on a Friday because often that's just a pullback, people getting out of their trades, squaring up for the week, especially the last 2 hours of the trading day. So I don't want to be in on those ones. Instead, I just want to be in on the middle of the week where all the action's happening. Same with the daily candles. I don't want to be in the Asian session when it's drifting around. I want to be in now during London, during New York. That's when I want to be taking my trades. Does that make sense, guys? Cool. So just to follow up on the New Zealand, I'll go ahead and put my stop loss. I'll go ahead and put my stop loss up here above the weekly candle, 82, so 88.22, 88.23. Yeah. And I'm going to put my sell order below the low of that candle. The low of last week was 86.48. So again, 86.42, 6 pips lower. That's a pretty solid price. And that's my entry price. So the market has to make a new low to get me in, right? And then what about target? Obvious target down here at 85.55. And then the second target would be down here at 84.50. We'll go 84.55 actually. It's 100 pips lower. So that's target 1. Or sorry, that's target 2. And then target 1 would be up there. And there's actually another target, a really good one actually, at 83 even. That's actually a brilliant one. So if, for example, let's say it was just too close to take profit at 85.55. I don't like the risk to reward on that one. Maybe you just move to break even at 85.55 and then hold out for 84.55 and 83. Those are really sweet looking. So this is my Kiwi trade. That's how I see the Kiwi. I see the Kiwi falling. And I'm willing to bet if you threw up some sort of momentum or I'm looking for divergence and we have it. See what I'm talking about, guys? Look at this. Here is your downtrend on momentum, and yet it's divergent with price, which has been going up. Higher highs on price, lower highs on momentum. I reckon this one is ready for a tumble. So that looks really good. I really like that one. I don't care if it ends up being a loser. I still really like the look of this. So looks good. Cool. Any other questions or pairs or anything, guys, before we shut it down? So I'm in on the euro pound sell, right? I'm in on the pound Swissie buy, right? Looking for 54.38 and 55.50. So it's kind of a similar thing to the euro pound, but it's sort of in reverse. Not quite the same, but same kind of move there. And I'm probably going to get triggered on my Kiwi trade. I think I have a really good shot at that happening, given it's at 86.63, so it's only like 21 pips away right now. So it's pretty good. Cable. Yes, I hope that the cable moves up. Cable's been in this sort of little weird channel thing, and it's on support right now. This would be a really good time for the cable to bounce and go up. Don't know if that's going to happen. The problem with the cable is it hasn't given us a nice price pattern yet. This is the spot to do it. Essentially, as a naked trader, what I do is I wait for the market to get to these sweet spots on the chart and then print a pattern. So we need to find a reliable pattern here. We don't have that just yet. Maybe we'll see it on the lower time frame first, but I don't, not yet. So my thoughts on the cable is it's acting like a bullish windsock, like a bullish sort of retracement down here, and then it's going to rocket up. That's what it's acting like, but we still need confirmation that it's not going to bust through this level. The other thing that would do it is a really big green candle. I thought we had that back here, but see how it snapped back and closed really weakly? So because it closed in such a weak manner, it meant that it wasn't really a good trade. So it should have closed. If it closed all up here, that would have been a trigger candle, right? Just like we talked before. And that would have been a great setup, but we didn't get that. So. All right, guys, anything else? Okay, cool. Thanks so much for your time. I wish you very happy trading. I'm glad that the explanations are really clear. Awesome. Cool. Beta, did you send it to Beta, do you have this email? Okay, cool. All right. Thank you very much, Kieran. Bye, Chris. See you, Glenn. Thanks, Pan. Yep, thanks, Beta. Okay, cool. Have a wonderful night, guys, or day, depending on where you're at. Thanks for your time. See you soon. Have fun out there. Bye.